It does take us to our talk of the tape. A pivotal 2 weeks coming for stocks. The tech earnings, the election. Oh, yeah, Fed meeting, too. For what's at stake, let's welcome in Professor Jeremy Siegel of the Wharton School. Welcome back. It is nice to see you and have you with us, as always.
Thank you, Scott. Happy to be here.
Yep. How's this market look to you?
It looks strong to me. I don't see any really drop in the momentum. I mean, I think it surprised everyone. It certainly surprised me. It surprised the Fed. GDP is going to be reported next week and looks to be over 3%. We're moving into the fourth quarter, I think, at 2.5% to 3% rate. And by the way, what that means, I think long-term interest rates are going to continue their uptrend. I still think the Fed is going to lower them, but certainly not as much as they said or as many of us felt. It could be a quarter point, or it might even be a pause if we get a strong labor market report a week from today.
Okay, so there's a lot in there, and I want to take it sort of step by step. The backup in yields has obviously made the market a bit uneasy. How much more do you think they could back up? And as long as yields are going up for, quote unquote, the right reason of the strong economy that you mentioned, is that okay for stocks?
Yeah, that's okay for stocks. It's actually better okay for the tech stocks and the big cap stocks than it is for the value stocks and the small stocks, which rely more on the short-term borrowing. So the realization that the Fed is not probably going to go certainly as low as we thought a month ago, I think is one thing that has been keeping a lid on those stocks over the last month.
Okay, so you expect 2 to 3 pauses and 3 to 4 rate cuts over the next 6 meetings.
Correct.
Are you suggesting in any way that we could get a pause before this calendar year is over because how strong the economy is?
Yes, I definitely do think so. And, Bowman, finally, objected in the last meeting to the 50 basis points. So, Powell had a record of no dissents, and now people might dissent. It could, if we get a strong labor market report for the month of October, there's going to be a lot of people, a lot of those FOMC members that are going to say, maybe we should pause at this particular juncture. So it's between a pause and 25. If I had to go, I would say 25, but I'm looking at next Friday. And of course, probably even more important, looking at the following Tuesday. Mm-hmm. We haven't yet talked about the biggest event in November, and that would be the election, of course.
What do you make of the positioning that's been around the election? I mean, some would also suggest that the reason why yields are rising is because of a more inflationary agenda, maybe from both parties, but particularly if you're talking about a whole slew of tariffs and the attempt, let's put the attempt to re-up a bunch of tax cuts, if not institute new ones, obviously depending on what Congress looks like after November 5th.
Well, long rates can rise because of inflation, but they also will rise if there's strong economic growth. There's also will rise if there's fear of a big bump in the deficit. So what really, as important as the president selection is going to be a week from Tuesday, what's going to happen in the House of Representatives? We pretty well know the Senate is going to turn Republican. The House looks very, very close. If there's a sweep by, let's say, the Republicans, I think there could be a spike in long-term yields, because then they'll say, hey, the Christmas tree is open. Whatever tax cuts the Republicans want, they could get. If the House flips to Democratic, and by the way, we may not know that for 2, 3, 4 days, but if it does, that's a check and balance. And I think the bond market would take that more calmly than they would be a sweep by any party.